Hi, Susanna Kunkel, owner and founder of the Lux Living Group, with another market update. Here we are, mid-May 2021, and there's a lot of looking back on this past year, of course, this unprecedented market that we're in, and trying to sort out what's coming next. If you follow my blogs or subscribe to YouTube, as I hope you will see I often compare watching the market like what pro surfers do. In fact, there's a video, watch the market like the pro surfers who stand on the shore and study the waves before they ever get in the water. So guess where I have been standing on the shore, watching the market reports, and not to use a different sports analogy, I feel like I'm watching a tennis match, between the different opinions about, is this a bubble? Is it going to burst? Or, oh, other people saying the exact opposite, to say this isn't the mortgage crisis, there's nothing to worry about. Well, when they said that a year ago, I knew that that wasn't appropriate, because just because it's not the mortgage crisis doesn't mean there might not be something to worry about, especially with the national crisis. I'm an ode to Hawaii. I'm wearing my vintage Hilo Hattie Aloha blouse today, partly because I did sell real estate on the resort island of Kauai during the mortgage burst. I started in 2004, so I got the tail end of the easy money coming in and had a great year in '05, '06, and then '07 was our tsunami year. I'm very sensitive to market changes and tend to be a little conservative, having seen the worst of the worst. And so I was very concerned, honestly, a year ago when I heard CEOs of brokerages and mortgage companies minimizing forbearances. And you may have seen that and heard me. And it really scared me to my core, because I was afraid homeowners would be entering into something that they did not understand with the balloon payment due. Now, the misinformation is a fact. I mean, I always put my sources. However, the good news, the aloha, is that most of the people who went into forbearance, first of all, I believe it says about 70% opted in as a just in case protection. In fact, 25 to 30% who were in forbearance and exited actually never missed a payment. So it was just a safety net from the majority of the owners that went into forbearance, because they weren't sure if they'd lose their job or what could happen. And that's a smart move. So, when you're watching market statistics, this is why I always like to look at all angles and multiple sources of information, because if you just look at the statistic that almost 9% of Americans are in forbearance, that can sound horrendously scary. And, some of the market prediction of waves of foreclosures come from statistics like that. I'm going to share at the end of this a direct link. We'll listen to Rick Vargas. He's Executive Vice President of RealtyTrac. I like to tap into data sources where they're not selling the data to make people feel better. Like, his business is based on tracking foreclosures, and of course they sell the data. People subscribe. Their major consumers are consumers directly, not realtors, to get information about pre-foreclosures and foreclosures. So they do sell data, but I've found other sources that are selling realtors, marketing services, and so on, tend to kind of like tell us what we want to hear, not necessarily the bold truth. So I like to resource him, and you can watch him in a moment from a podcast last week. But he highlights what was predicted, in essence, by market analysts a year ago. And Gary Keller talked about, likely we would see a K-shaped recovery from, or you want to call it recovery, economic impact of COVID. And at the time, it seemed like somebody should be dancing the Village People, because they're talking about, would it be a U or a V or a L, or what kind of recovery would it be? And unfortunately, or fortunately, depending on which part of the K you're in, we are in a K-shaped response, meaning there were 22 million jobs lost, but about 65% of those have been recovered. However, there's a vast difference between the higher net worth jobs, the service sectors that are financially based in technology versus the service workers at hotels and restaurants, and the lower paid jobs, where people are more at risk, have been hit the hardest. Um, so you'll see, that's why there are micro markets and micro economic syndromes, if you wish. But the foreclosure wave, the majority of the lower income people, unfortunately, are renters. And so that's another topic where when the moratorium on evictions is lifted, we are going to have a situation none of us can actually predict, a horribly heartbreaking likely situation. And from a foreclosure real estate standpoint, that's hitting hardest with the family owned landlords, the mom and pop rentals, because with the eviction for moratorium, those tenants haven't been paying rent. That's our biggest risk of foreclosure. Are really the lower priced properties, the um, the multi-units owned by families, and that is heartbreaking because those are the basis of generational wealth. So if you know anyone in that segment that needs help, please call me right away. I have a network of professionals that can help people find a solution. And with the increase in equity, they may be able to at least sell, get out of that situation, and then buy again, in 6 months or a year, or maybe 2 years when there are some other good opportunities that may come up. Now, the top part of the K would be more of the luxury market. And interestingly enough, Kevin Gillen, in his in-depth market analysis for Philadelphia, done a couple, you can see the link. Whoops, I'm pointing the wrong way. To that video as well. It's an hour long. But he noted similarly that the higher priced properties, there's been over 10% 10% increase in median home values in Philadelphia. In fact, the median home value broke the 200,000 mark for the first time in history during this last year. Um, will that be sustainable? In the higher priced properties, is more likely that those values will be sustainable. Where it's more likely to have damage in the future is the lower priced properties. So there are different micro markets, different little currents. You can't just give one answer to where we are in the market. Flashing back to real estate in Hawaii, when values got, escalated because of the easy money, you can tell the difference, even though we didn't understand what was going on, between what I would call intrinsic value, like an oceanfront resort property, versus single wall constructed, basically kind of, I hate to say it, but they're homes that are built kind of like a shed, with not just a little quarter acre. Those got swept up in the flurry, and those values, probably never seen again. But the resort properties that, tumbled, and I helped many high net worth individuals with 2 or 3 properties that needed to offload their second homes to do successful short sales. That is possible with a luxury property, and those have rebounded. Now, Philadelphia and the mainline are not Hawaii. We have unique markets, but my own personal perspective, especially on the mainline where my clients and yours as well are probably paying, 105 to 110% of asking, sometimes more. Those escalated values are more likely to be sustainable. The 1.2 million home that sold for 1.45 million, that value is more likely to be sustainable because of the shift in dynamics that we're seeing throughout the country. So those homes now have that intrinsic value, like an oceanfront property with the swimming pool, with the lifestyle post-COVID demand for this kind of quality staycation type home is not going to go away. So those homes that provide that, in my opinion, are more likely to sustain those increased prices. Now, the two things that can impact this escalated value that we're seeing are an increase in inventory and an increase in interest rates. So those are things that we need to be very sensitive to, even in the upper part of the K, in the higher priced homes. So, we'll talk more specifically. I don't like to give sort of general advice, but if you're thinking of selling, now is really, really a strategic time to look at how that could work for you, because of the fact we don't know the future. Values aren't predicted to crash. Um, However, if interest rates go up, if more inventory comes on the market, this prime opportunity to get the most for your home may never be recreated, because it's such a combination of so many dynamics that we are responding to but don't have control over, like the interest rate and the economic impact of government solutions to COVID. And now, with restrictions lifting and confidence building, we're starting to see a resurgence in Center City a little bit. It's like spring, the Rittenhouse condo market, and that's a whole nother blog article and report, but just a little taste. And seeing personally uptick in a slight uptick. It's like the flower breaking through the concrete in the MidTown and Rittenhouse lower priced condos. I would say under 600,000. The bottom of the market, I can confidently say, was December, early January in the Center City condo market. But there are still some really viable opportunities to buy now. And I do believe if you wait, it will cost you more. So before I get too sidetracked, because there are so many stories to go over and so many markets to report on, let me introduce my guest speaker, so to speak. He's actually with someone else's guest speaker on a podcast, and I'm just going to share it with you here so you can hear specifically from the expert about what's going on with the foreclosure market. So here we go.
A little bit about foreclosures, right? If you think back, Rick, to when we were talking, a year ago almost, there was a lot of questions. Certainly, we had no idea what was going to happen. So let's get a quick update on that. Let's get an update on sort of the moratoriums that I think had been planned to be lifted in the June-ish timeframe, and just what are you seeing in terms of forbearance requests and things like that?
So the bottom line is that foreclosure activity has been ticking up slightly over the last couple of months. And our read on that is the reason the numbers are going up is because some states are now making it possible for lenders to foreclose on vacant and abandoned properties. And that's good. That's good for neighborhoods, good for communities. Vacant and abandoned properties are always a safety hazard and an eyesore. During a pandemic, they become even more of a safety hazard because who knows who might be squatting in those houses, and you could have pandemic related issues. So I think the states opening up the door for some of these foreclosures on vacant properties is good. That said, we're still running at about 80% below year-ago levels of foreclosure activity. And last year, entering the pandemic, foreclosures were already running at about half of the normal rate. So very strong loans, a lot of equity, record levels of homeowner equity. The pandemic moratorium was supposed to end last December. It's now been extended through the end of June. I'm almost positive it will be extended through the end of September at this point. The forbearance program, which was scheduled to stop in March, had another 6 months added to it. So people that are in the forbearance program and are able to skip their mortgage payments temporarily have another reprieve. But what I will tell you is this, that the number of people going into forbearance has continued to go down week over week, really since the program peaked back in late March a year ago. So almost nobody's entering the program right now. And the people that are exiting are doing so extraordinarily successfully. 88% of the people who left have left either by having their loans reinstated, by continuing to make payments, by entering a loan modification or repayment program with their lender.
Wow.
And even the people that aren't leaving don't appear to be going delinquent, because even as people have left the program, we've now had 6 consecutive months where mortgage delinquency rates have gone down every month. So for all of the headlines you read about serious delinquency rates being so high and millions of people being in danger of foreclosure, The numbers suggest just the opposite of that. The numbers suggest that the people who are the volume of people who are in trouble, who are potentially in distress, might be vulnerable. That volume continues to go down, and the people that are returning to normal payments are doing so very, very successfully. And that's why, Randy, I don't believe that what we're seeing suggests we're going to see an influx of massive numbers of foreclosures anytime soon.
Yeah. No, Rick, thank you for that perspective. It's pretty amazing, isn't it? Right. Again, I think back to the conversations that we had and I've had with others, rewind the clock basically a year ago, a little more than a year ago now. And, it was potentially cataclysmic, right? These lenders did not write plans that had this many people, in a forbearance program, and we didn't know what was going to happen. And the industry really, I think, rallied, and a lot of things, worked out quite well. And so to hear you say this, I think is fantastic, frankly, that most people have come out of it. Did it turn out to be the case that a lot of people preemptively entered a forbearance program, even though they had jobs? They didn't necessarily need it. And I'm not saying that they were being disingenuous. They just didn't know what was going to happen. Did that turn out to be the case?
Well, let's not sugarcoat it. Some people were disingenuous.
Sure.
There's always a percentage of people in programs like this who see an opportunity just to not make that monthly mortgage payment for some extended period of time.
Yeah.
And it wouldn't surprise me even a little bit to find out that one of the factors leading to record level of savings rates in the country are the people who are putting that $1,500, $2,000, $3,000 a month into the bank instead of sending it to the lender. But it's the way the program was set up. LendingTree did a survey early on in the forbearance program and concluded that about 70% of the people in the program didn't necessarily need forbearance, but the majority of them had opted in as a just-in-case scenario. They weren't sure how stable their jobs were because of the pandemic, and wanted to take advantage of the protection if it were available to them. So they did. And I know a lot of those people have been the ones who have exited. Surprising percentage, somewhere between 25 and 30% of the people in the program who have exited never missed payment, even though they were in forbearance. So,
Wow.
So yes, that really is the case. And look, we can't sugarcoat this. There were 22 million people that lost their jobs.
Yeah.
We've recovered between 60 and 65% of those jobs. Most of the jobs that were lost by renters. They were lower paying jobs in industries that typically hire people without more formal education, people that are younger workers, people that are making lower wages, and they're disproportionately renters. And that's one of the reasons the housing market hasn't been impacted as much as you'd expect. But because of the eviction bans that are in place, protecting a lot of those renters, there are a lot of landlords who are susceptible right now. And I would not be surprised to see a spike in foreclosures and bankruptcy filings by landlords who can't evict a tenant who's not paying and can't afford to continue fronting the payments themselves when they're not collecting rent. We're already starting to see incidents of those landlords selling off their properties. We're also going to probably see some fallout from FHA borrowers. So if you look at the delinquency rates, FHA borrowers are running 2 to 3 times higher than everybody else. FHA borrowers typically have less equity because they put lower down payments on their properties. They typically have higher debt. They typically have lower cash reserves. Those are the borrowers. So if you're in a market like Atlanta or Tampa or Orlando, Chicago, areas with a high percentage of FHA borrowers who are delinquent, you might see a spike in that kind of activity. So there are areas where we'll see vulnerability. The third one would be low dollar value commercial properties. The commercial market got slaughtered during this recession, retail and hospitality in particular. So you could see a lot of limited service hotels. You could see a lot of small retail outlets going into foreclosure. And honestly, in our RealtyTrac database, we're already seeing 5 times the normal number of commercial foreclosures with loans of $5 million or up. Now, I don't say that to be alarmist. That means instead of seeing 10, we're seeing 50. So it's not a huge number, but it's still 5 times the normal level. And so that does suggest that the commercial market's been hit a lot harder than the residential market.